Index funds are a type of mutual fund or exchange-traded fund (ETF) that aims to track the performance of a specific market index, such as the S&P 500 or the Nasdaq Composite. Instead of relying on a professional fund manager to select individual stocks, index funds invest in all the stocks that are included in the index they are tracking. For example, an S&P 500 index fund would invest in all 500 companies included in the S&P 500. The idea behind index funds is to provide investors with a low-cost, diversified investment option that closely mirrors the performance of the overall market. By investing in an index fund, an investor can gain exposure to a wide range of companies and industries without the need for extensive research or analysis. Overall, index funds can be a good choice for investors who are looking for a low-cost, diversified investment option that provides broad exposure to the overall market. Here are 5 big benefits to investing in index funds. Before starting, don't forget to like and subscribe to our channel for more future updates. So, let's start. Number 5. Accessibility. Accessibility in investing refers to the ease with which an individual can invest in a particular asset class, investment vehicle, or financial product. An accessible investment is one that is easy to understand, easy to purchase, and easy to manage. Accessibility is an important consideration for many investors, particularly those who are new to investing or who may have limited financial resources. An investment that is easy to access can help level the playing field and allow more people to participate in the markets. One way to increase accessibility in investing is through the use of technology. Online investment platforms such as robo-advisors have made it easier than ever for individuals to invest in diversified portfolios of stocks and bonds, even with limited financial resources. Mobile apps and online trading platforms have also made it easier for investors to buy and sell individual stocks and other securities. Accessibility can also be increased through the use of financial education and literacy programs. By providing individuals with the knowledge and skills they need to make informed investment decisions, these programs can help break down barriers to entry and increase access to the markets. Overall, accessibility is an important consideration for investors who are looking to build wealth over the long term. By choosing investments that are easy to understand, easy to purchase, and easy to manage, investors can potentially increase their chances of success and achieve their financial goals with greater ease. Number 4. Consistency. In the context of investing, consistency refers to the ability of an investment strategy to generate returns that are relatively stable over time. A consistent investment strategy is one that is able to deliver returns that are predictable and reliable, with relatively little variation or volatility. Investors often value consistency because it allows them to plan and budget for the future with greater confidence. Consistent returns can help investors meet their financial goals, such as saving for retirement or a child's education, without having to worry about sudden market downturns or unexpected losses. One way to achieve consistency in investing is through diversification. By spreading investments across a variety of asset classes, industries, and geographies, investors can potentially reduce the impact of market fluctuations and achieve more consistent returns over time. Another way to achieve consistency is through a long-term investment strategy. Investors who adopt a buy-and-hold approach, for example, can benefit from the power of compounding over time, allowing their investments to grow steadily and predictably. Consistency can also be achieved through the use of passive investment strategies such as index funds or exchange-traded funds, ETFs. Because these investment vehicles are designed to track a specific market index, they tend to be more predictable and stable over time than actively managed funds. Number 3. Passive management. Passive management is an investment strategy that involves investing in a portfolio of securities that closely tracks a specific market index, such as the S&P 500. The goal of passive management is to achieve returns that are similar to the overall market, while minimizing costs and maximizing tax efficiency. In passive management, the portfolio is designed to replicate the holdings of the index it is tracking. This means that the portfolio manager does not actively buy or sell securities based on market conditions or individual stock performance. Instead, the manager simply adjusts the portfolio holdings to match the composition of the index it is tracking. Because passive management does not require extensive research or analysis, it typically has lower management fees than actively managed funds. Additionally, because the manager is not making active trading decisions, the fund may have lower transaction costs and be more tax efficient. Passive management can be a good choice for investors who want to achieve broad market exposure with lower costs and lower risks than active management. However, it may not be appropriate for investors who are looking for the potential for higher returns that may come with active management strategies. Number 2. Low costs. Low costs refer to the expenses associated with investing in a particular security or investment vehicle. In the context of investing, low costs are generally considered a positive attribute, as they can increase an investor's net returns over time. When it comes to investing, there are several costs to consider, including management fees, trading fees, and taxes. Management fees are the fees charged by the fund manager or investment company for managing the portfolio. Trading fees are the costs associated with buying and selling securities within the portfolio, and taxes are the taxes owed on investment gains. Low costs can be particularly important when investing in index funds or exchange-traded funds, ETFs, which are designed to track a particular market index. These funds typically have lower management fees than actively managed funds, as they do not require extensive research or trading. Investors can also reduce trading fees by investing in funds with a low turnover rate or by using a broker that offers commission-free trades. Additionally, investors can minimize taxes by investing in tax-efficient funds or by holding investments in tax-advantaged accounts, such as individual retirement accounts, IRAs, or 401k plans. Overall, low costs are an important consideration when choosing an investment vehicle, as they can help increase an investor's net returns over time. By minimizing fees and taxes, investors can maximize the amount of money they have available for future investment growth. Number 1. Diversification. Diversification is an investment strategy that involves spreading your investments across multiple asset classes, industries, and geographies. The goal of diversification is to reduce risk by investing in a variety of assets that are not perfectly correlated with each other. When one asset class or industry underperforms, other assets in the portfolio may continue to perform well, offsetting potential losses. By diversifying your portfolio, you can potentially reduce the risk of losing money due to market fluctuations or economic events that affect specific industries or regions. For example, if you invest only in stocks in a single industry, such as technology, your portfolio may be highly vulnerable to fluctuations in the technology sector. However, if you diversify your portfolio by also investing in bonds, real estate, and other asset classes, you can spread your risk and potentially reduce the impact of any single sector downturn. Diversification can also help you achieve better long-term returns by reducing the impact of short-term market fluctuations. By investing in a broad range of assets, you can smooth out the ups and downs of any one asset class. Over time, this can help you achieve more consistent returns and reduce the overall volatility of your portfolio. Overall, diversification is an important investment strategy that can help you manage risk and achieve more consistent long-term returns. By spreading your investments across multiple asset classes, industries, and geographies, you can potentially reduce the impact of market fluctuations and better position your portfolio for long-term growth. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comments section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.